you need to know about money market accounts today. But before we get there, there has been some huge upheaval in the banking world just this past few days. In other words, Silicon Valley Bank and Signature Bank just went bankrupt. Yeah, here's a recent Wall Street Journal article. Signature Bank, SVB Bank, collapse. But there may be some good news here in that this article points out both the Federal Reserve and the Treasury Department, so Jerome Powell and Janet Yellen, both kind of collectively came back and said, well, we're going to designate this as a systematic risk to the financial system. And what that allows them to do if they choose is they could give them the flexibility to backstop any uninsured deposits. So meaning those that are above the FDIC insurance limits, potentially they may come in and make those investors, those account holders whole. So we'll see where that leads, but it's a pretty interesting development in the banking world. Consider one of the big reasons why these banks collapsed is because interest rates are through the roof. And that's what we're talking about today, because the wealthy already have figured out that interest rates are high and they can go out and get a money market account that is yielding a really nice rate of return on your interest rates. So here's another article from the Wall Street Journal that talks exactly about that. So it says here, at Fidelity, one of the nation's largest, there has been a double-digit percentage increase in the people using cash management accounts, because these money market accounts let customers earn competitive interest. Pretty meaningful. In other words, people are putting money in these cash management accounts because of the interest rates they're paying. But first, if you've come here to earn better interest on your money, and like my daughter Morgan, you ate raspberries off of your fingers as a kid, then go ahead and hit subscribe down below because it keeps her raspberries stocked. So let's get into it. Because if you have money in a checking account or savings account at a big national bank, you're probably not making much of anything. In other words, here we are this week on bankrate.com. These are the interest rates that a checking or savings account is paying for Wells Fargo, Chase, Bank of America. And you can see here the best of the bunch is Wells Fargo paying 0.15%. Ouch, that's pretty lousy. Versus money market accounts here today through various sources, we can expect to yield between 4.4 and 4.6% over the course of a year. That's huge. That is a whole lot better than what you're going to get in your checking or savings. Now, I want to be clear about this. Having a checking account, savings account, they are FDIC insured. And for the day-to-day cash management, they're really important. In other words, paying bills, getting a check deposited, they're really convenient. But if you have more than 3 to 6 months of emergency fund kind of cash in your checking or savings, this might be a really good opportunity to get a lot better interest on that money. So there we are. We mentioned that money markets are not FDIC insured. So that begs the question, well, how does a money market work? So here are 3 kind of things to know. One, they are very safe and stable, even though they're not FDIC insured. So the second thing is generally they are liquid. You can get the money out when you need it. And the third thing here is you can get market-based yields, meaning there is no locked-in interest rate. Yields fluctuate on a daily basis depending on what the value of these money markets, what the value of interest rates are paying. And because interest rates have been so low for over a decade, money market rates really haven't paid anything until recently. So over the last 12 months, Jerome Powell has been forced to raise interest rates because inflation has been such a problem in the economy that all of a sudden money market rates are paying a whole lot more than they have in a long, long time. So this is an opportunity. And because this is such a good opportunity, the next question is, well, could we just lock these great interest rates in for like a 10-year period or even longer? But that isn't available today. In other words, the yield curve today is not a normal, it's an inverted yield curve, meaning the short-term rates are actually paying more than long-term rates. So here we see a chart based on U.S. Treasuries, and we can see interest rates today. So short-term is right around 4.8% today. But if we wanted to go out 5 years or 10 years or even 30 years, you're actually sacrificing, you're taking less interest to lock in that period for an extended period. Meaning, Today at 4.8% is where the Treasury overnight rates are. But if you wanted to lock in for 5 years, you'd be at a roughly 3.7%. Or if you're going all the way out to 30 years, you're a little north of 3.6. So almost a full percentage point less than where you could get a money market today. So yes, you could choose to go out and lock that money in for a long period of time, but you're actually going to get less yield, less interest for it because of it. So the next thing we want to think about is, well, you said they're safe, but they're not FDIC insured. So that begs the question, well, how safe? Okay, well, what we need to think about when we talk about this is $1 is invested in a money market at $1 per share. So if you had $10,000, you just bought 10,000 shares in that money market. So really the question we're asking is, have money markets ever broken the buck? Meaning, has anyone put $1 in and gotten something less than $1 out? And the answer is yes. It's actually happened twice. So the most recent one, money market breaks the buck and freezes redemptions. And this happened in 2008. It was around the Lehman Brothers collapse. And you'll see here, you put $1 in. What did you get back? Well, some investors only got 97 cents. Meaning they had a 3% loss. So relatively not a huge loss, but yes, they did lose money. Here's another article that we can see here, 1994, and then the most recent one is around the Lehman Brothers. Both of those times, the 94 one was 96 cents, and we just saw the 08 one was 97 cents. So pretty well 3 or 4% loss, but not a major, huge loss, thankfully. Hey, the big idea here is if you're getting 0.1% on your checking or savings account, you could move those funds to a money market and get 40 times or more the interest. That's huge. Hey, thanks for watching. If this has been helpful, give it a thumbs up, and you can even put a raspberry on it.